In 1776, we did not come over and say, it'd be awesome if we could have some venture bets or whatever these are on the government balance sheet. No, it's kind
You haven't read the 26th Amendment? Thou shalt be allowed to have venture bets.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
The S&D clan is back. That's the Skippy and the Doogles. We got three things that's trace for y'all people that be multilingual today. First, there's a very useless quiz that I need to give to you to educate your mind, Skippy. Second, we going to discuss the Intel drama that happened. And then last, I want to pick your Brizzy whiz, that's a brain. I want to pick it about stock buybacks. You want to add anything to that agenda?
Sounds great. That was the worst intro you've ever done, by the way. I'm in a nice mood this morning, so.
Wow, Grumpy McGrumperson is back. Okay.
You made me wake up early for this, Doogles. I mean, come on now.
I did. I'm sorry about that. I apologize. Here's the useless quiz that we're going to start off with here. You know how sometimes people just sit around and they go, you know what I'm going to do today? I'm going to analyze the historical performance of every ETF that's ever existed. You know how people do that sometimes?
Mm-hmm.
Okay.
Yeah.
So I decided to do this, and this is going to be quick, but I just want to get your guesses on a few things. If you take end of 2024, every ETF that was on the Mizzy markets.
Okay, for those who don't know, ETF is an exchange-traded fund, which is like the newer version of a mutual fund, which is usually a collection of stocks or other assets. Okay, that's important. And then the benefit to ETFs as they grow is that they're much more tax efficient and often have lower fees. So today's ETFs are yesteryear's mutual funds, just in case people don't know that, Douglas. Go ahead.
That was so professorial. That was gorgeous. Look at you. You just got these things in your back pocket. I love it.
That's right. Let's go.
Okay, so if you take that group of ETFs and look at their median, all ETFs, their median CAGR, compound annual growth rate, just think about their average annual return, think about it that way, over the last 5 years, what do you think it was? Every ETF.
Well,
triple leverage NVIDIA is in there. Every ETF.
Tell me what the S&P did during that time.
S&P was about 14.5%.
Okay. That's good. And then there's a really important, I still have the professor hat on. There's a really important thing you have to describe here because people mess this up all the time. How did you handle survivorship bias?
Well, this is every ETF that existed at the end of 2024.
Yeah. Okay. So,
right.
Our listeners need to know that a lot of ETFs went bust in that time.
That's right.
A lot of people started up. Yeah,
you had to have existed from the beginning of 2020 to the end of 2024 in order to be in this data set.
And so this is going to change my guess, which is me just saying to the listeners out there that there are some ETFs that started 7 years ago, raised their 20 to 50 million seed funding, did all that, had horrible returns, or had no one else buy them, that closed up shop. They're not in Doogles' analysis here. And so that drag on the portfolio, those would be your worst performing ETFs in almost every case.
That's right.
Is not going to be included here.
Absolutely.
I'm going to go 9%.
4.7.
True, that's low.
Yeah, it's so low.
I did just realize, though, I was thinking they were all like equity blends, and you have a lot of like bond market ETFs and stuff that is intended to not perform and also had a really tough 5-year stretch. So I can buy that.
Yeah. I have such a hard time with something that is intended to not perform.
Intended to trade volatility. A lack of volatility for lower returns.
I get that. Okay, 10 years. So to your survivorship, before you even ask it, to that point, this means that you had to be around from the beginning of 2015 to the end of 2024 in order to be in this. What do you think it is? 10-year. Median CAGR.
Yeah, but it's still a basket of a bunch of garbage assets with conflicting assets. Do you have with some of these ETFs are like, we hold cash, it's like short-term treasuries or.
Just answer the question.
What's the S&P during the last 10 years?
S&P about 13%.
That's a good 10-year run for those who don't know. If you can make 13% a year, goodness. 10 years, we have, I'm going to say like 5%. I think it's slightly higher.
4.8. Okay. Slightly. It was the slightest of slights. Slightly higher. Okay. 15.
I mean, at some point. So 15 goes back. What's the formal start date on this? 2010. See, it'd be more interesting if it was like 2005. Let's go 4.5.
Oh, 5.5. We went the opposite direction. Okay, 20. Let's do 20.
Okay.
Let's do 20. 20 years.
Okay, so survivorship bias in this sample is absolutely crazy.
Yes, it's insane.
So many funds went bust during that time. And I can't figure out if that's what happened with the 15-year performance.
Of course.
Yeah, so this is a dumb guess. Oh, no, but so if you're starting in 2005, things are pretty bubbly. Just 5%.
8. It goes up. Survivor. As you were mentioning.
That was my initial inclination, was to go way up, but then I was like trying to deal with the 07-08 crash, and I couldn't figure out those two competing factors. 8 is crazy.
Right. That's right. So just to give you a sense, when you talk about survivorship, I'm going to round numbers here. At the end of 2024, there was something like 3,500, I think, something like that, ETFs. At the 5-year, the number that had been around for 5 years is about 1,700. Number for 10 years is about 1,000. Number for 15 is about 500, little over. Number for 20 is about 100 and something. So you can see the numbers that go down over time, and the numbers that have been created. Like ETFs now are getting created like they're flapjacks in your knapsack. Like it is so quick that they end up coming up, and then they'll probably go back down. And then you have some that perform awful, like ARK, and still stick around. Like ARK is awful during this time period. I won't even go to those numbers. We talked about that enough.
Yeah, but ARK has a PR machine that allows them to collect really nice fees. But no one wants to shut down their ETF, right?
If I buy an ETF, the PR I'm looking for is personal record at the market capitalization of your ish. I want your rates of return to be up. I'm not talking about the kind of PR you're talking about. Not talking about your marketing engine.
Okay. Let's talk ARK real quick. I can't believe you made me do this. So for those who don't know, ARK is run by Cathie Wood. Their flagship ETF is the ARK Innovation Fund, and they're buying all sorts of crazy nonsense that they think are going to perform crazy over the next 10 years, and it's like AI and robots and whatever. Is that a decent summary? So the reason that background for ARK is important is because she had the best performing fund of 2021, or one of the best performing funds.
I think it might have been 2020. I think it was 2020. Yeah.
Now, in retrospect, what appears to have happened is that fund got really large because it had great short-term performance and was putting money into small names, and effectively they were bidding up the stocks themselves. Right? So this is like if Doogles has $50 and I keep coming back to him every week with $5 million being like, I need more of your company, right? The price of the value of his company goes up. Doogles, the reason I wanted to bring this up, and sorry for the side tangent, is it's amazing no one, and I'm sure someone has and we're not aware of it, has tried to replicate that intentionally, simply to kind of scam investors and make fees.
Ooh, wow. That's dirty. One thing I'll add to what you said is that there's that plus Tesla in 2020. She loaded up on Tesla as well in that year. And I'm just going to give the 5-year here. So in 2020, I think ARK returned something like 120%. It was something like that. I can't remember the exact number.
Yeah, it's crazy. Yeah.
Yeah. The 5-year CAGR of ARK is like 3%. If in a 5-year period you have a year that returns 120%, and over that entire period it's 3% on average, like what the heck? Insanity. Okay, we can move on. Can we move on to topic number 2?
Let's move on.
Okay. All right, topic number 2, we're going to reach into that fishbowl and talk about the Intel drama from this week. I'm going to give the high-level points. If you want to add anything, you can. I don't know how long or short this segment's about to be, because you might just be like, move on. Here's what occurred this week. So at one point, the president of the United States, talking about the CEO of Intel, says, you cannot be the CEO. You have to resign immediately. There's no other action that makes sense to take but for you to resign because of your connections to Chinese companies, because you own a bunch of Chinese companies historically, that no other action that could happen. That was bullet point number 1. Bullet point Number two, the CEO of Intel comes out. He sends a note to his company. He comes out publicly and says, like, I only act in the utmost of ethical standards. Maybe I've owned some companies in the past. That has nothing to do with how I run Intel, yada, yada, yada. Step three, there's speculation that the President of the United States now wants to invest in Intel and says that the only way that the investment into Intel will happen is if the CEO stays the CEO. That's speculation. The president, I never heard the president actually come out and say that, but that was what was in the rumor mill. Intel stock, zoop, zoop, goes up like 7% in a day, a few percent like the next day. So has its best week in a little bit. Explain to me how that narrative arc came to be.
This is dumber than your quiz. I have no idea. I'm even an Intel shareholder over here. I have some that I haven't cleaned out of a dirty portfolio in the back closet, you know? Like, I don't think about Intel. I haven't followed any of this drama. The more interesting, or at least as interesting piece, is that at 3:41 Eastern on August 14th, someone bought a bunch of call contracts, option contracts for Intel to go up. And 2 minutes later, the news leaks that the administration wants something to do with Intel and the stock goes up 10%. Like, that's the more interesting stuff to me, because if you control the narrative and have the power of the U.S. government's finances, there's a lot of easy ways to make money. And it sure seems like someone had insider information here. I don't know how many people. Like, for all I know, this could be the reporter that was about to break the story. I don't know who it is, right?
Yep.
But my goodness, is this happening a lot in the past 12 months? And that's incredibly frustrating to me.
12 months is a little bit generous. What I would say is the volatility, to your point, the amount of volatility of bad news leading to things going down and then surprise good news with things going up and people buying options right before has been kind of curious in crypto and stocks. At one point, it wasn't even a question as to what happened because there was a post that came out that said, in about an hour, I'm about to do this. Like, it wasn't even like a backroom dealing. But yeah, it's really interesting. And the reason that I highlighted a couple of those points was to that exact notion. One of the points that I said was the earlier statement from this week was there is no other action that can take place, no other alternative but for the CEO to step down. And then a few days later, it was the CEO has to stay in place and an investment might be made. It's the extreme nature of the musts that lead to these shifts sometimes that I think is interesting, coupled with the options. I just think it's interesting drama. Never before did I have a bucket of popcorn and Fortune magazine open. Those two things usually don't go together, but somehow this week they did.
I'm just happy my kids don't read the Wall Street Journal, right? There's some really impressive tactics taking place here to create turbulence, create confusion, whatever it is. It's like you're saying. It's like make this absolute statement followed by this absolute statement that appear to contradict themselves. And I think the market, let's go back to the market, the NASDAQ and the S&P. I think generally people are just fatigued by all the turbulence in the air. And at this point have decided after the initial tariff chaos and everything, gosh, I don't have time to update my spreadsheet every 3 days to break down Nike's supply chain with different tariff rates that change every 4 hours. I generally think people are just I don't know. I think I'm going to buy some stock and go have fun.
Unless you have the Excel keyboard shortcut knowledge of an iBanker, you cannot update your models fast enough for how quickly some of these things shift.
Listen, I tried all through April. It was nonstop. Every 3 hours there was some new news, and it was just incredibly taxing mentally. And I think everyone else is there now where they go, we'll deal with it. And then I can't even trust it. To your point, what if your Intel trade was based on the first statement?
Yeah.
Or what if your Intel trade is based on the second statement? Not to even mention that the second statement would be, based on my understanding of the law, highly unusual and potentially illegal. I mean, we did not create a government. In 1776, we did not come over and say, it'd be awesome if we could have some venture bets or whatever these are on the government balance sheet. No, it's kind
You haven't read the 26th Amendment? Thou shalt Be allowed to have
some
venture bets.
intel after you insult the CEO. There you go. Buy some, like, that whole thing is they're not writing any check.
Oh man, it's a big bet on semiconductors. I mean, if something along those lines happen and you take the 15% revenue share from Nvidia and AMD, let's see if that stands up in the court of law. I don't know, but
that appears to be clearly illegal as well.
Yeah, a strong bet on semiconductors at the top of the market. All right, third topic, fishbowl. Third topic, stock buybacks. So I do want your view, legitimately, genuinely. I want your view on this. So there was a Wall Street Journal piece that came out recently. The title is American Companies Are Buying Their Own Stocks at a Record Pace. There's this chart in here, just to give you a couple figures, where roughly 1.3 trillion-ish of stock buybacks have been announced in 2025, and that is larger than any year in the past 20 years. Then you take the amount of buybacks that have happened, it's a bit lower, the year's not over, so we'll go ahead and see. But so one thing that's important to note here is when you're comparing absolute dollar figures to previous absolute dollar figures, you have to think about the relative amount. And so the U.S. stock market has also grown a material amount over this period of time. Like in the last 15 years, it's grown by like 3x. So if you take that, you have to take it relative. But regardless, the thing that I want your view on is, do you think this is meaningful in any way? Do you think the fact that companies are looking to buy their own stock are meaningful in any way? I can think about ways where maybe it is, but I just want to get your view.
Yes and no, but mostly no. So, yeah, let's first talk absolute numbers. I'm going to use the announced buyback figures. So in 2007, it's like $0.85 trillion. And today it is maybe $1.3 trillion. Okay.
Yep.
You mentioned that the stock market has gone up roughly 3x since that time. So if we were talking about X the 2007 number, I think it's a much more meaningful. I think this is pretty much dollars got huge. There's several multi-trillion-dollar companies that happen to be flush with cash and really like buybacks. I read last week or the week before that something in like the last 24 months, Apple has spent enough money buying back their own stock that they could have bought like 470 companies on the S&P. Right? Like they could have bought any of the.
Yeah.
It's highly skewed by a few big names at the top, which is why I lean towards no. I mean, basically nothing is happening.
And
here.
This is where the one place that the question raises in my mind, but I might be going to Never Never Land too much. But the question that comes in my mind, taking what you just said, let's just take it as fact without the exact numbers, that Apple could have bought 470 companies from the S&P 500. Instead, they bought their own stock.
Yeah.
The question that I have is this a sign that even if it is some smallish group of companies, they don't see investment opportunities, whether in other companies or even in growth for their own stock? If they're looking at, I have this big pool of cash, what do I do with it? The best option they have is to buy their own stock, not when it's cheap, mind you. Whether or not it's expensive, who knows, the future will tell, but definitely not when it's cheap. Does that say anything about growth investments in the future?
Okay, there's
That's
lot
a question.
there. The main answer is no, but okay, so there's a lot of reasons to buy back your stock. The best reason is when it's fundamentally undervalued and the return from purchasing your own shares is significantly greater than the return from developing a new product or anything else, right? Hiring new people, etc. Because the stock market is near all-time highs, it's tough to argue, again, holistically across the market, that people are making great asset allocation decisions. More likely, it's like, my bonus is tied to this, or I don't know what else to do with the money, exactly what you're saying, right? The companies that I respect most, and it's so funny because the immediate name that comes to mind here is Alibaba, just because I followed it closely and I used to own a bunch of it. But they were very much like they'd buy more when the stock price dropped, and the stock price dropped significantly and was low for an extended period, and they're buying back gobs of it. And so it seemed like every 6 months they'd announce another huge buyback initiative, but it was relative to the price of the stock. I don't really think that's what's happening here as much as this is a good talking point for management teams. And they don't have a great other place to keep the cash. Now, I want to tie this in, and please don't let me go too far from your topic, but to break down from Michael Mauboussin, who we talked about last week on cash holdings in businesses. And the only thing I want to talk about here, we're not going to talk about the paper. We're not going to go in deep detail, But
Okay.
there's a high-level argument that says with the rise of the intangible economy, right? So 100 years ago, what showed up on a company's balance sheet was like the railroad cars and tracks.
The factories.
And factories, right?
Yep.
The like actual tangible stuff. If that company gets into trouble and needs debt, they go to the bank and say, like, look at my factory, look at all the steel that I have in the yard, et cetera, et cetera. Yep. Today, Apple, Microsoft, whoever is not sitting on assets like that. So it naturally makes sense for them to sit on more cash. And that's been widely reported from Apple and Microsoft and Google's cash balances to Berkshire Hathaway's cash balances. Everyone seems to be sitting on a bunch of cash. And for the last 10 years, I mean, this really started with Apple. People have been like, why is Apple just sitting on, in some case, hundreds of billions of dollars worth of cash, whatever the latest balance is. This article argues that simply that's a shift to how the economy works today, and that you have to hold more cash because you don't know when the rainy day is coming and you don't have assets that you can easily get debt against because it's all intangibles. I find that to be a fascinating point that I think kind of buys in here, but really I think the natural thing that happens is when you're sitting on a bunch of cash, the management team goes, well, shouldn't we be buying back our own stock rather than just sitting on treasuries?
So as part of your point there and how you're relating it to this is you're saying, let's go to Novo Nordisk, we were talking about recently. Okay. If it was Novo and they have a bunch of cash, they could be like, let's open another production facility because they manufacture. If you're Apple and doing that, you can go, are we opening another store? I mean, that's a very different kind of equation. Or what else can we buy? We're already investing in these other places, so it's our own stock. Is that kind of what you're saying, that there isn't a natural, like, big physical thing that they typically will invest in, so it makes sense for them to invest in the intangible, which is their own stock?
Largely, yes.
That's interesting. Yeah. The takeaway I had was similar to what you had before, which is I don't think it's that meaningful, especially when you take the relative percentage versus the absolute dollar amount. It doesn't seem that meaningful, but it's interesting to me, even if it's just a bullet point, that at a time where it's pretty not cheap, independent of where we are in the market cycle, it's just like not cheap out there that you have this much money being spent on stocks. I just thought, I was like, that's an interesting bullet point. And so I wanted to raise it with you and see what you thought.
I'm trying to find the exact number, and I don't know if I'm going to be able to find it. I'd love to see this. Well, here's some context, okay? We talked about the total expected buybacks yearly to be about 1.3 trillion, and the authorized buybacks in 2025 for some of the biggest names, Apple's like 100 billion.
Yep.
Alphabet's almost 70 billion. I mean, the top names here are really driving the boat. I love Share Cannibal. I mean, a lot of my holdings are ones that buy back stocks like clockwork. It's a tax efficient way to reward investors. So I'm not going to complain about it, but I don't really think there's a larger point here. I think it just kind of is what it is. And if you look at past cycles, I mentioned in 2007 that it was like 0.85 trillion. And then in 2009, it was like 100 billion. I mean, right?
It was like $6.
People are going, and that's the right time to be buying back your stock in 2009, right? Yes. But you're so scared that your company might not exist. Of course, you're not buying back stock.
Yep, so that's right. Cool. Is that a wrap?
I think that's a wrap.
All right, everybody. Thank you. SkippyDoogles@gmail.com. You can send us listener mail, your questions, your thoughts, your provoking anecdotes. I don't know, anything. Send it to us. Thank you for listening, and we'll see you next week.